One other trader, what we found was using one of our platforms. I mentioned the reason we had access to all this data is because we had access to the brokerage, and they were using Alpesh B.Patel spreads. That gave us access to the data, and we could see who was making money, who wasn't. What we also discovered was that chart patterns were very popular. Now, one of the things that's been added onto the platform is where you may know that certain prices make patterns before a breakout. Let me explain that in another form. This, for instance, is a falling wedge. Why? Because it looks like the price has made a wedge formation. And there are certain rules as to wedges and flags and all sorts of other names. And the problem in the past was that we had to look at these by eye. We had to look at them and then judge, okay, what's a breakout? Well, a breakout from a wedge, when it's falling like this, which is an ever-increasing boundary between the price is turning points. So you can see it's moving essentially in this kind of funnel direction. And a breakout is when it moves above this upper boundary. Now, thankfully, software does this for us. For instance, the brokerage Alpesh B.Patel spreads has this on it. So I'm not just trying to push that, but what I'm actually saying is you can either do it by eye, or you can have the software do it for free on a website. But we found this was interesting because we found some of the winning traders, what they would do is they take the work out of it for them. And they could pick any time frame. This can be, or any security for that matter. And when these patterns were flagged up, whether it was foreign exchange or equities, whether it was intraday or end of day data, what would also be shown at the breakout point was the breakout and what the target was. What you see here in faint terms there is the price action thereafter. So the notification would come at this point and what the target was, and the lower boundary of the target and the upper boundary would be shaded. So that's the most that was expected, that's the least that was expected. So you could see already what your profit target was. It's going to be from this entry point here to here, or from the entry point to all the way up here. So that's your entry point, the breakout. Let me just clean up the screen for you, Link. There we go. So that's the entry from the breakout. That's the initial target. That's the secondary target. So that's the first bit of profit we might make. That's the second bit. And you can see from these faint bars, I've shown you one which actually worked because it did indeed do that, and so on. How do we know this is going to work? Well, there are certain patterns which the software looks for and then finds a breakout. And that's exactly what, as I say, some successful traders did. Here's another example. This is also a falling wedge over a different time frame. And what you can see here, point C marks the initial entry point. Point B points the secondary target. Point A shows both the secondary and the primary target, as it were, of where we think profit might hit. So you knew where to enter and you knew what you were likely to make. What about your stop loss? Stop loss should be just beneath the breakout. The reason for that is if you're right and this price is going to go in that direction, it has no business going back beneath that line. You're able to have a stop loss should be less than the profit you're expecting to make. In other words, your reward is greater than your loss, and that's simply done. The great thing about software now is you can either do this by eye, and you can see these patterns, or as I've already pointed out, computers generate this kind of information for you as well. Of course, you could just keep it really simple, which is what we found some winning traders did. These were the longer term ones. They just hold on to a stock where they saw an upward trend. Simple. That's the Warren Buffett way of trading. They just saw stock, saw a nice upward trend, and just held on to it and planned to hold on to it forever. And why not? When you look at, say, something like McDonald's, and you see in 06 it was just around $30, and it's tripled in value, you've made quite a bit of money anyway, so why wouldn't you do that? That's the simplest of all strategies that we saw amongst winning traders.